Introduction to financial risk. In the business finance ecosystem, risk is unavoidable. Every investment, financing, or operational decision carries a degree of uncertainty. Financial risk management is the practice of identifying, analyzing, and mitigating the potential losses that a firm may suffer due to various financial exposures. In simple terms, financial risk management protects a company's value by managing threats to its financial health. Financial risks can erode profit margins, disrupt cash flow, affect capital structure, or even lead to insolvency. Effective financial risk management ensures business continuity and sustainable growth. Types of financial risk. Understanding the types of risks is the first step in building a mitigation strategy. Financial risks include 1. Market risk. The possibility of losses due to changes in market prices, such as interest rate risk, currency exchange rate risk, commodity price volatility, equity price movements. 2. Credit risk. The risk that borrowers or counterparties will fail to meet their financial obligations, leading to bad debts or defaults. 3. Liquidity risk. Occurs when a firm cannot meet its short-term financial obligations due to lack of liquid assets or market access. 4th, operational risk losses due to internal failures like fraud, system breakdowns, or human error. Not traditionally financial, but with financial consequences. 5. Legal and regulatory risk potential losses from non-compliance with laws, tax regulations, or government policies. 6th, reputational risk. While not directly financial, a tarnished brand image can drive customers and investors away, causing indirect financial risk. The financial risk management process. The risk management process is systematic and involves the following key steps. Step 1. Risk identification. Identify areas of exposure. Examples: a firm exposed to Forex risk due to importing goods. High receivables from customers in a declining industry. Heavy reliance on debt with variable interest rates. Step 2. Risk assessment and measurement. Quantify the likelihood and impact of risks. Use metrics like value at risk, VAR, expected loss, EL, credit ratings, stress testing. Step 3. Risk mitigation strategies. Design strategies to avoid, reduce, transfer, or accept the risk. Step 4. Monitoring and review. Ongoing tracking of risk exposure and strategy effectiveness using dashboards, reports, and KPIs. Tools and techniques in risk management. A variety of financial and analytical tools are used to manage financial risks. 1. Hedging. Using financial instruments to offset potential losses. Derivatives, e.g., options, futures, forwards, swaps. Natural hedging, matching assets and liabilities in the same currency. 2. Insurance. Transferring risk to a third party, especially operational or property risks. 3rd. Diversification. Spreading investments or revenue sources across markets, industries, or products to reduce unsystematic risk. 4. Internal controls. Establishing policies, audits, and compliance checks to detect errors or fraud early. 5th. Risk transfer. Passing the risk to another entity via contractual arrangements, outsourcing, or partnerships. 6. Credit management policies. Credit scoring of clients. Use of credit limits and trade credit insurance. Value at risk, VAR, and scenario analysis. Value at risk, VAR, estimates the maximum potential loss in value of a portfolio over a defined period for a given confidence level. Example: 10 million Naira portfolio, 5% daily VAR equals 200,000 Naira. There's a 5% chance the firm will lose 200,000 Naira or more in a day. Scenario and stress testing, simulating worst-case events such as a sudden devaluation of currency, interest rate spike, commodity price crash. These help firms evaluate resilience under pressure. Types of budgets. In this course, we will be using budget type and purpose in our table for today. 1. Operating budget. Forecast revenues and operating expenses. 2nd. Cash budget. Predicts inflows and outflows to manage liquidity. Third, capital budget. Projects major capital expenditures and investments. Fourth, master budget. Consolidates all functional budgets into a comprehensive. Fifth, financial plan. 5. Flexible budget. Adjusts with changes in business activity or volume. 6. Zero-based budget. Starts from zero and requires all expenses to be justified anew. Foreign exchange and interest rate risk management. Forex risk mitigation. Matching currency inflows and outflows. Using currency forwards and options. Holding foreign currency reserves. Setting pricing strategies that adjust for Forex volatility. Interest rate risk mitigation. Fixed rate versus variable rate borrowing balance. Interest rate swaps. Prepayment of high-cost loans. Maintaining reserve buffers. Enterprise Risk Management, ERM. ERM is an integrated, organization-wide approach to risk that includes financial and non-financial risks. It aligns risk appetite with strategy. ERM components: governance and risk culture, strategy and objective setting, risk identification and response, information, communication, and monitoring. Frameworks: COSO, ISO 3-1000. Financial risk management in Nigeria and emerging economies. Firms in Nigeria face unique risk exposures: high inflation, currency instability, volatile interest rates, power and infrastructure risk, inconsistent regulatory framework. Risk management in such environments includes building reserves for inflation, hedging against forex movements, reducing debt reliance, diversifying revenue streams, e.g., expanding to Francophone West Africa. Case study: Dangote Group problem. Dangote imports raw materials exposed to USD/NGN exchange rate volatility. Solution: hedging with forward contracts. Natural hedging by increasing dollar-denominated revenues exports. Strengthening risk unit with real-time risk dashboards. Impact: improve predictability of cash flows and stronger investor confidence. Summary and review. Financial risk management is crucial for value preservation. It requires proactive identification, quantification, and mitigation. Tools like hedging, diversification, VAR, and insurance are essential. ERM ensures risks are managed in line with company strategy. Nigerian businesses must deal with complex local risk conditions and need tailored responses. In modern finance, risk isn't to be feared but to be managed strategically.